So I think we have a major asset category shift underway here, a topping process in the stock market. In fact, the biggest stock market bubble we've ever had in terms of duration and dimension from 2009 to the present. There's no bull market in US history that matches that. Even 29 top didn't match it, .com, et cetera, et cetera. So we have a bubble there, but we have a deflated bubble in the commodities that wants to reassert itself. And our technicals tell us it's going to do it. And I think that's a place for investors to look. And it will be in part a consequence of the breakage of the stock market, because the stock market breakage will cause movement of assets out of a broken category into that which is perceived to be low risk, higher reward, commodity category.
Welcome.
Here's our view. It's been our view for a while. We think the S&P, the stock market in the U.S. has been in a topping process for a year, since early last year. The problem is that when you go back and look at the tops in the S&P, like 2000 .com top, 2007 mortgage crisis top, it's laborious. It's not like, oh, that's it, it's all over in a spike and you collapse. No, it doesn't happen that way. In fact, our momentum work in each of those two prior cases said it's topping before it actually made its final spike high in the process. So it was laborious, but the momentum indicated early enough that, this guy's running out of gas. He's floundering. And in each case, there was this final spike. Oh boy, what damn, great, new high. Back several months ago, if you'll look at an S&P chart, you don't have to right now, but if any of your watchers,
I'll pull it up here.
Punch up a monthly S&P chart that's on the right side there.
Yeah, here's your report. Here's the monthly S&P chart.
That's it. Yeah. Look at those are monthly bars going back to 2021, 2020, I think. But anyway, look at the cluster of bars that just occurred prior to the recent upside spike. The last 4 or 5 monthly bars.
This isn't a commodity rally. It is a rotation, the kind that happens when a 1-6-year equity bubble finally runs out of structural support. The S&P 500 bull run from March 2009 to the present is, by duration and magnitude, without precedent in US market history, longer and larger than 1,929, longer and larger than the .com peak. Michael Oliver's technical work has been tracking momentum divergence on this structure for over a year, and what he is about to describe is not a prediction.
That March cleansing low in price, where you swept the Feb low in price, momentum made a low and broke out above that multi-point trend line and rallied up to back above the 50-day, above the zero line, and in a sense gently pulled back. You close above that red line and close above the high close on that oscillator that occurred a few weeks ago. And we regard this as a fully shifted intermediate trend situation. Gold has a similar situation.
Okay, so with silver, that's what, 80?
Yeah, let me put it this way. Instead of getting specific, because the numbers change every day. Why? Because we're looking at a 50-day average and it's declining right now. Okay. It requires not only getting back above that average, but getting above the close that peaked above it several weeks ago. When you clear that, this momentum pattern goes into a full positive zigzag, meaning, okay, I'm back, okay? I cleansed the low of February to no avail. I built structure, and now I'm headed back up. We think getting back over 80 again in silver is a table pounder.
Okay, got it. So silver, that's about 10%. Gold, are we talking?
Gold, you get above 4,800 again, and I'd say, wipe your brow if you've been panicked and assume. Now, the numbers will change, and we deal with that in our reports. So I can't give you the numbers because they literally change week by week, day by day. And we're looking at different metrics other than this. But we had already plotted before that low occurred, by the way. We'd already plotted that red line, and we had enough of a rally late in March to pop back up to close right on that line. It was April, March, And then April shot up off of it. Now, what that means is, if you're merely looking at the momentum chart, which is our prime focus, momentum will usually lead in transitions of tops or bottoms. It'll usually lead price. Well, you don't see it on the price chart, but you see it on the momentum. This is clearly a topping situation. You've already broken your channel. You've now developed almost a flat floor there by the red line. 3 times, bang, bang, bang. You now have what we call a structure. You close below that structure, and as far as we're concerned, that's it. It's over. You are headed down this time for real. Doesn't have to crash, but it will begin the downside. And those numbers are not very far below the market. They're like in the 6,600 level on the S&P, which is sort of, if you go back to the price chart, 6683 in next month. In this month, or by June, 6785 will break that. Mm-hmm. You can see the red circles. In other words, if you pull price back into those red circles on price, you're going to be blowing out that momentum structure. Similar things going on with NASDAQ. We don't have to discuss it in detail. Now, think about this for a minute. A broad commodity asset category trading in the 50s, but in 2008, it was trading at 237. Mm-hmm. Okay, so is that a cheap asset category or not? Okay.
Sounds like it.
Okay, now, either we don't need commodities anymore, we're going ethereal, okay? Or we still need them and we made a mistake, okay? Most commodity components within the Bloomberg have turned up on our annual momentum. The Bloomberg, in fact, turned up last October. Price then was 106.50. It's since surged up to 140 and actually taken out the high that was seen in March of 2022. But most of that move occurred before oil even woke up. Mm-hmm. Again, oil broke out in January at 65. Heck, the Bloomberg broke out in October on momentum. The Bloomberg was already well up in the 110, 120 before the war even occurred in March, meaning the excuse for the Bloomberg going up was not simply oil. It was a lot of the underlying components, base metals, grains, etc. So I think we have a major asset category shift underway here, a topping process in the stock market. In fact, the biggest stock market bubble we've ever had in terms of duration and dimension from 2009 to the present. There's no bull market in U.S. history that matches that. Even 29 top didn't match it. And what we're looking for on gold and silver right now, and the miners, are metrics that are shorter term than what we just looked at on the stock market and bonds. Why? Because frankly, the long-term trend metrics of gold and silver are in no manner near or even close to jeopardy. Which the sharp drop we just saw doesn't even put them in jeopardy when you look at long-term momentum of those markets. It's just a down tick. Okay.
So just, sorry, stepping in, but a lot of people here are invested in the precious metals.
Yeah.
A lot of them were in before the big price run. Some other ones jumped in, at much higher prices. They've all been kind of biting their nails for the most part since mid-January because, all right, they've gone through pretty material corrections, silver especially. I hear you saying, I'm not worried at all.
No, I'm not. What we're looking for, first off, if you look at a monthly chart of gold, you don't see it here. The collapse occurred really one day. The last day of January was the huge collapse you see on that daily bar chart. Look where it was then, okay? You're trading right around there now. Go to the left, go to the big collapse day there. Look at that close. It was about 4,700. The next day in early February got down to 4,400.
Okay, yep.
That was your first low. It was basically a 2-day sell-off. Okay.
What separates Oliver's framework from headline-driven analysis is the sequencing. The Bloomberg Commodity Index broke upward on momentum in October. When it was priced at 106.5, oil had not yet moved, base metals and grains were leading, and the war had not occurred. By the time oil broke out at $65, West Texas Intermediate in January, and later surged to $117 on conflict headlines, the underlying structural shift was already 90 days old. Investors who bought at $110 on the news were not early. They were late. And Oliver is precise about what comes next for them. A gut kick back toward the $80 to $85 range before the real trend resumes. The signal, as always, preceded the story. When you zoom out, The technical picture here resolves to two simultaneous mean reversion trades, converging at once the longest equity bubble in recorded US market history, beginning to top, and the most deflated commodity complex in a generation beginning to reassert. The Bloomberg Commodity Index has already taken out its March 2022 high, silver above $80 and gold reclaiming $4,800 are the confirmation levels Michael Oliver has identified as the next table-pounding entry signal. Momentum led price in 2000. It led in 2007. And by his reading, it is leading again. Now, the topping process is laborious, not instant, which is precisely what makes it dangerous to dismiss. The real risk is not holding commodities through a correction. It is remaining allocated to an equity structure that has never, in its entire 16-year duration, faced the combination of higher real rates, supply-constrained energy, and a momentum rollover of this magnitude